What's up, guys? I'm back. I'm back. I'm back again. I'm back. I'm back. Y'all don't care. I know y'all don't care. My bad, y'all. You know what I mean? Like, what you want me to do? I'm sorry. Like, I got stuff going on in real life. I'm setting up stuff as we speak, throwing thumbnails in. And we gonna get into this video because, I mean, I'm still looking to buy a house and I've been listening and hearing a whole bunch of stuff about what's been going on. So without further ado, we gonna get into the worst housing crash in 40 years. And I'll roll a clip.
What's up, Graham? It's Guys here, and it finally happened. U.S. housing prices just saw the largest single-month deceleration in 40 years, leading analysts to believe that housing prices have officially hit a tipping point. Month over month, national home prices have declined 0.77%. And even though that doesn't sound like a lot, it's begun to create a substantial shift within the entire housing market, with Goldman Sachs believing that more price drops are likely to come soon to a market near you. So let's discuss exactly what's happening, the brand new housing data that was just released, which markets are most likely to be impacted, and then finally how you could use this information to make you money.
And I thought this was a great video for me to come back on and touch on because, I mean, everything from the projections that I'm seeing, everything is going to start crashing, from the housing market to the auto market to like just different assets in itself. And unfortunately, people are probably going to start losing their jobs too. So we just going to have to sit back and wait and see. Another thing that sparked me to have another conversation about the housing market is I found someone else talking about the fact that banks are starting to push. I want to say, I forgot, it was a credible news source, and they were saying like one of the ways for you to lower the interest on your mortgage if you're looking to buy a home in the next couple of years is for you to get an adjustable rate mortgage. Now, for those of you who don't know, the reason that there was such a huge crash in 2008 with the housing crash is because everybody was getting these adjustable mortgage rates, loans. And when banks started to increase the rates on their loans, people couldn't afford it. So people just stopped paying. So that was one of the key factors for why the housing market crashed last in 2008. So we're going to sit back and get a little bit educated on this and, you know, we'll see what's going on.
I guess not lose money depending on which way you look at it. Although before we start, as usual, if you enjoy videos like this where I talk...
Oh, and the point I meant to make was don't buy and this isn't financial advice, but don't buy a house with an adjustable mortgage rate because you could have it could be the good thing about right now is the interest is so high that it should be going down, but I would still say get you a fixed interest rate so that you know what you're budgeting for instead of them increasing it 1 or 2 more percent and you not being able to afford the house that you live in.
About the unbiased facts, studies, and data, it would mean a lot to me if you hit the like button and subscribe for the YouTube algorithm.
Subscribe.
It's totally free. It takes you just a split second, and as a thank you for doing that, here's a picture of a mantis shrimp. So thank you guys so much, and also big thank you to Omaze for sponsoring this video, but more on that later. All right, so all of this begins with a report from Black Knight Research, who monitors the market on a regular basis to determine housing demand, delinquency rates, prices, affordability, and a variety of other metrics that basically tell us, are housing prices going up or are they going down? And this last month was quite telling in terms of which direction we're headed. First, let's talk about mortgage refinances. This is when a homeowner takes out a new loan to replace the old one, usually with the intention of being able to restructure their payments, extend their loan term, cash out profits, lower their interest rate, or otherwise be able to keep the property for longer. And in July, every single aspect of refinances dropped to its lowest level ever reported in history.
And that obviously makes sense because most people refinance their home to take out the equity in their house, but they also refinance their home usually if there's a lower interest rate. So say me, for example, say I'm impatient and I decide that I want to buy a house right now, and the average of interest rates for a home loan right now is about 6.7%. Give me 2 or 3 years down the line, the interest rate, hopefully we can pray on it, will be maybe 2-3%. So what I would do is I would refinance and get a whole new loan for the home that I'm in so they can lower the interest rate on my loan. And obviously that would lower my monthly payments. On top of that, if I had equity in the house, I could pull some of that equity out if I wanted to. Because, I mean, in the next 3 years, this $1 million house might be worth $1.2 million, and I can take the $200,000 out and, you know, use it maybe to pay off credit cards or whatever you guys have.
The second, that then leads us to home prices. As they report, the housing market has officially shifted from slowing down to a decline in July, with median prices falling for the first time in 32 months. Now, of course, there is the narrative that, but Graham, housing prices are still 14.5% higher than they were a year ago. And yes, that is true, but as they point out, most of that growth occurred in the beginning of 2022 when interest rates were still at historic lows. But now with interest rates continuing to increase to their highest level since 2000.
It's at 6.7 now.
2008, prices are beginning to turn around. That means that annual price growth in July was the fastest single-month deceleration in more than 40 years, falling during a summer month that usually increases. And third, they noted that some markets are being hit worse than others. The largest decline so far is awarded to San Jose, California, with a 10% drop in just the last 3 months, along with San Diego, Los Angeles, Riverside, Portland, Las Vegas, and finishing off with Richmond, Virginia, with a decline of 1.1%. All in all, more than 85% of major markets have seen a decline from their peak, with more than a third seeing a decline of at least 1%. But in terms of what this means for you and what their data says is most likely going to happen, here's what you need to know. On the surface, the biggest issue is, no surprise, home affordability. Black Knight mentions that with prices beginning to decline, this last July was one of 10 of the least affordable months in the last 3 decades, with almost 33% of the median household income to purchase the average home. Because of that, they mentioned that it would require some combination of a 30% rise in incomes and a 2 percentage point decline in 30-year rates, or an additional 20% plus pullback in home prices to bring home affordability back in line with long-run averages. Even more,
or all of it. I'd argue that they need all of it, because when the housing market started to boom and everybody, had all this extra money and went and they bought all these houses, they inflated the housing prices like tremendously. I mean, not just houses, all assets, like cars. Like the car that I'm in has went up in value, and it's a used car, and it's just like everything is inflated. And I feel like the Fed is using these raising interest rates to bring down inflation. So not only does inflation have to go down so he can lower the interest rate, but we also need to see a correction in the housing market, because people can't afford these homes. So it is going to be a bloodbath.
More surprising is that the monthly payments needed to purchase the average home are still 41% higher from the start of the year and 75% higher since the start of the pandemic. As a result, fewer buyers are able to afford the typical home on the market, leading to more inventory beginning to build up, which, let's be real, is desperately needed. Now, don't get the wrong idea, because inventory is still well below the historic average, but should these conditions persist, they estimate that we would cross the 6-month inventory threshold by December, tipping the market in favor of buyers for the first time in recent years. Even though this sounds alarming, and it is, as of now, the vast majority of homeowners still have positive equity in their homes, meaning they owe less on the home than what it's worth. And even if prices declined by 5% nationally, less than 1% of those homes would be underwater, which is an amount that's still well below historic averages. And even with the...
And that's good, because in 2008, the thing was, once the houses, they started to fall, like the prices in the houses, they started to fall because people couldn't afford to pay their houses. So everybody tried to sell them at the same time, and they couldn't afford the payments. The value of your house, if you paid $1 million for this house, but your house is only worth $800,000, you're underwater $200,000, so you can't even sell the house, even though you can't afford it. So that's really what caused the market to crash.
The 15% decline in price, fewer homes would be underwater than we saw back in 2016. But keep in mind, this is just one data set from one company, and others like Goldman Sachs have a slightly bleaker outlook in terms of the future of housing. Although before we go into that, as both a homeowner and a real estate investor, people underestimate just how many miles and how much wear and tear you end up putting on your car,
like
going to showings, coordinating repairs, and making last-minute trips to Home Depot right before they close because your toilet float valve just decided to suddenly break. True story. That's why I've partnered with Omaze, their newest accelerating 637 horsepower and
That's a nice car, though.
made the exact.
Sorry, Graham. We don't care.
Let's get back to the video.
Thanks.
All right, now in terms of the future of housing prices, even though Black Knight reports on past data, others like Goldman Sachs use that data to then predict what they think will happen in the future. And according to them, they believe that nearly 40% of markets will see a decline throughout 2023. Why, you might ask? Well, they noted that 1 in 5 sellers have already begun to drop their asking prices, with the median price,
including this house that I'm living in, dropped it $200,000.
It's declining from $449,000 at the peak to now just $435,000. In addition to that, the average home now sold for less than the list price for the first time in more than 17 months during the 4-week period in August. Now, in terms of which locations had the largest price drops, areas of Boise, Idaho, Denver, Colorado, and Salt Lake City, Utah took the lead, with more than 50% of sellers having dropped their price in order to get the home sold. This also continues throughout many of the largest regions, with more and more sellers beginning to compete against each other for a smaller pool of buyers because interest rates have increased. As a result,
so what do I think about all of this? I think as this continues, and because everybody, especially in my neighborhood, I live in a wealthy area in New York, in Queens. I think as people like continue to hold their property and they start to realize that, because once one person starts to drop their price, everybody's going to start dropping their prices, and people want to get out of their houses. Like, people aren't just holding on to these houses for no reason. People want to move. They want to do this, that. So before, like when during this demic was going on and people were just like not asking for inspections, paying $50,000, $100,000 over the asking price, all of that stuff is going to come back. People were starting to ask, I mean, when they show this house, they get inspections and everything, because it's starting to turn into a buyer's market. And the thing about it is, the longer people hold on to their properties, if they want to get rid of it, the more desperate some of these people are going to become. And that's why people continue to drop their prices.
Goldman Sachs came on record to say that we expect home price growth to stall completely, averaging 0% in 2023. Well,
we expect run that back. We expect home price growth to stall completely, averaging 0% in 2023. Oh, it's probably going to go down.
Expect home price growth to stall completely, averaging 0% in 2023. While outright declines in national home prices are possible and appear quite likely for some regions, large declines seem unlikely. However, there is one curveball to all of this that we all need to be made aware of, and that would be the upcoming Federal Reserve rate hike. See, mortgage rates are indirectly influenced by what's called the federal funds rate. This is the interest rate set by the Federal Reserve that determines how much banks charge other banks anytime they borrow money. And when that interest rate increases, other interest-bearing products go up as well. All of a sudden, things like savings accounts, bonds, CDs, and treasuries offer a higher return, and as a result, mortgages have to charge more to remain competitive. After all, why would you pay 3% to buy someone's 30-year fixed-rate mortgage when you could get 3.5% risk-free for buying a U.S. Treasury? That's why over the last few months, we've seen mortgage interest rates skyrocket to a 14-year high, as both investors and banks expect interest rates to go up even further. So what you pay is a combination of supply, demand, and higher interest rates that get passed back on to the customer. Now, even though some of these rate hikes have already been priced in, the Federal Reserve recently came on record to say that while higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation, which basically means interest rates are going higher and there's nothing you could do about it. As of the time I'm making this video, the market currently believes that the Federal Reserve is 82% likely to implement another 75 basis point rate hike on September 21st, meaning we could soon see the
and they did.
highest interest rates since 2007. This comes as they continue to battle inflation that's substantially above their 2% target, growth has not slowed down, and demand is still there. Even though this is
Okay, I think that's enough. There's like 3 minutes left on that. This happened back in the day. I can't remember what year it was, but what the Fed ended up doing, I don't want to guess, so this is going to be a guess, but I want to say the interest rate got up to about like 11%. And what the Fed did is they just hit people in the head and raised it all the way up to 12% just to get it to go back down. So I'm hoping from some of the people I'm watching, we don't have to do, like, they're slowly doing this. And what other people that I watch that are smarter than me were saying is they need to kind of just make it happen. Like, give us the 9-10% interest rate that you need to give us. And people are going to lose their job, and it's going to be unfortunate, but it is what it is. that's all I got for y'all. Hit the like, comment, share, subscribe. I appreciate y'all rocking with me. And you know what? What exactly is the debt ceiling? The debt ceiling. Mike, the debt ceiling. You talking about the government's debt ceiling? I don't even know what their debt ceiling is, what we can even call it, because it's always raising. And the thing about it is with the United States and the fact that we're the people in charge of printing the money, we continue to raise our the debt ceiling. So I want to say it was a guess off the top of my head, maybe 26 billion. And they just continue to raise it, like doing stuff like PPP loans and all of this stuff. Let me see if I can look it up real quick. Debt ceiling in the U.S. They continue to raise it. And the thing about, I was wrong. It's 31.4 trillion right now. Last time I looked at it, it was 26. It was 28.5 trillion in 2021. So the thing about our government is because most of other countries, they use the dollar. The dollar is the standard. We can print out money and we can spread the inflation all around because everybody uses the dollars. Whereas somebody like China who uses the yen, people don't use the yen. So their economy is going to collapse because I don't know how they're going to get out of that situation because people, they can't spread the inflation to everybody else because only the Chinese use the yen versus America who uses the dollar, and we pass that along to everybody else. So if the reason why we're going through inflation and that's spreading all across the world, so the world is going through inflation as well. So anyways, that's all I got for y'all. I gotta go get my kids. Hit the like, comment, share, subscribe. Appreciate y'all rocking with me. And once I get through this hurdle with my career and my real life, I'll be able to do these a little more often. I'm trying to, get a bag on top of a bag. And then I got a whole bunch of fun stuff planned for this channel. Like, comment, share, subscribe, and